my mind. Looks like we're in the click, 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 just living the
What is going on, you guys, and welcome back to another update video for our series on the channel where we are building a portfolio live for you guys to ride along shotgun. Just a brief reminder, if you haven't caught any of the previous episodes, we have a playlist on our channel where you can go and really follow this progression from start to finish. But I'm here joined with my father today. Dad, what's going on?
Hey, Brian, how you doing down there in the Lower Mainland?
Pretty good. Yeah. I noticed two new things on you today.
Okay. One,
we both got
obviously,
we both got new haircuts, and that was actually unplanned. But also the AirPods. I see you upgraded to the AirPods.
Yes. Well, just trying to keep up to date with technology, and I hated those cords dangling from my neck here with the previous setup. So
cordless is the way to go these days. I'm such a fan of the AirPods. We're supporting our Apple pick that we added to the portfolio a couple weeks back. We actually added 3 new holdings that we want to share with you guys today, and I think we should start this recap off with just diving into the portfolio update. I'll put on the screen and take a look at our Questrade portfolio to begin with. This portfolio today is sitting at $20,914. I have highlighted in a little red box for you guys. One of the suggestions we got was to actually go through the holdings right up front because some people forget. Well, let's do exactly that. In the Questrade portfolio, we are holding shares of Apple, Disney, Google, Lockheed Martin, Pfizer, which we're going to talk about later today, and the company Tencent. As we can see, our best performing stock of the bunch looks to be Google. This one's up about 6%, not too bad from our initial purchase. The rest of them are all hovering between, the plus or minus 1% range. Tencent being the lowest performer, or the weakest performer, down 1.5% since our purchase, and we're going to talk about that later. On to the Wealthsimple account. Well, this account is looking today at $21,041. Total of 7 positions in this account. Bell Canada is our top performer of the bunch, up just about 3%. Clorox was a stock we added last review. Canadian National Railway is our top performer. This one's up 3.92%. Enbridge, Kirkland Lake, we're going to get into that. Manulife Financial Corp, and then Q-Tip. So that brings us, Dad, to a total portfolio today of $41,956.08. And I would just like to remind everybody that we are adding an additional $1,000 to each of the respective accounts each and every month. Just FYI, as a little teaching point with these platforms, Questrade, I was able to set up a automatic deposit or a PAC, a pre-authorized contribution or deposit. So that's coming in every single month automatically. With Wealthsimple Trade, they don't have that feature available. So what I had to do was actually just go in and do the monthly contribution on the first, and that's something that I will continue to do. But that's just a little teaching point on both of these platforms. But yeah.
I would add to that. I love the automatic ones because you don't have to be proactive, right? And if you're able to just set that up, and it's sort of a force to discipline, and you have to be proactive to go and cancel it if you want. But so it's better to have that option available. But with the option of doing it manually, that's I guess
it's the second best. It's not the end of the world, but absolutely being able to automate and kind of set it, forget it. That is the best way. The forced savings habits, but. Again, each of these platforms do have their little restrictions, and that is one of the ones with Wealthsimple Trade. By the way, we got a comment in one of the other videos saying we don't ask you guys to like the videos enough, and we probably don't, but for the algorithm, if you guys enjoy this series and you support the channel, that is a huge way of supporting us by just dropping a quick little thumbs up. We're going to get into all the insights in just a second, but let's move on to our Q&A section of the presentation today. And I believe you prepared actually a few questions that you clipped, Dad. Do we have any particular order that we want to go through? We're going to answer 3 today and then move on into the stock picks.
No particular order, but let's just go through those. And man, we got a ton of questions, and this is where I'm going to say I wish we could answer them all, but we clearly can't. We tried to find the ones that were most popular, so we can kill a few birds with one stone. If you do, for future videos, if you see a question that you like, you want answered, go ahead and give it a thumbs up, or I guess you can give it a like, and that will move it to the top of the most popular, and that's where we'll know most of the interest is in.
That's what we did, and we even kind of compiled a couple questions into one. And I guess we'll start off with the first one. I'll read one of the questions, and this is one from Quang Nguyen. It says, "Hi, thanks for the video. I'm learning a lot." Thank you, Quang. "Wondering if instead of building your own portfolio, why don't we just get in all into one ETF like Vigro that does self-balancing. And we had a number of questions asking us why we are not using ETFs and going for individual stocks. And I think that can be our discussion point number one.
Sure. And yeah, there were multiple people asking that question or a variation of that. And I'll just take it away, Brandon, and I'll just say the issue of whether you want to build a portfolio using ETFs or mutual funds or individual securities really does come down to a personal decision. The effort of this particular series is to teach people how to build a portfolio and covering the gamut. And if you want to use individual securities, I mean, quite frankly, just buying ETFs, we wouldn't be able to instruct in that way. So
it wouldn't be the most exciting series.
Well, it probably wouldn't be as exciting, but also it wouldn't be as instructional because I think it's if you know how to pick securities or how to build a portfolio using securities, and you want to switch over to using ETFs, that's a pretty easy transition. If you're just buying ETFs, and there's nothing wrong with that if that suits you, and then you want to go to individual securities, then you're kind of going right back to the beginning and learning. So this is covering off both of those bases. It really is a personal choice. Through my career, I always chose, well, I didn't always. I started off years ago using mutual funds when mutual funds were the thing, 25 years ago. Then I did evolve, I guess you would say, into using exchange traded funds predominantly. And the main purpose of that was to lower the fees. As ETFs became more widespread and more available, it made sense to lower the fees because you're buying, in many cases, essentially the same product.
Very similar product, yeah.
Did that. Then at one point, beyond that, I went into individual securities. And although I did still use ETFs for certain purposes, and I do think that they play an important role in a portfolio right now, a lot of my clients wanted to own individual securities. And I just, I found it to be a more interesting, more hands-on, and I just like the control. I would say the number one reason you would want to do that is the control. Mm-hmm. And I'm thinking, just a quick example, I don't want to go too long on this, but if you own an ETF, you own an index, you're kind of just, you have the broad index and that's fine, but you may want to be a little more fine-tuned than that, and you may like a certain sector, or you may feel you don't want exposure to a certain sector. Well, if you buy a broad, a TSX index, well, you're going to have a large chunk of your percentage in the banks, in the energy sector, in the material sector. That's really what you're going to be owning for the most part. Mm-hmm. Well, maybe you don't want to be in the energy sector, so you don't mm-hmm. have a choice. If you manage the portfolio yourself, you can just peel that sector entirely out if that's your choice and build it there. Another quick point, I would say from a taxation perspective, if you own a fund of some nature, you're at the whims to some degree of when they pay the dividends out and the form of taxation. If you own your own securities, you can completely control whether you're getting dividend income or interest income or when to trigger capital gains based on your own circumstances. So there are pros and cons to both. The biggest con, and that was, I think one of the questions addressed this, was it's a lot more work, and it certainly is. It's a lot more work to manage an individual portfolio, but those are kind of the pros and the cons. I'll just go back to where I started. It depends on the individual. If you have the time, the interest, build a portfolio of securities. If you just want to own equities but have a broader index and not worry about it on an ongoing basis, buy an ETF, perfectly fine.
Well said. And it's not to count out that, at some point we may even use an ETF. It's not to say we're never going to have ETFs in the portfolio. We may use some for some, direct exposure to a specific area. We would not count that out rather than picking individual stocks. But
I would actually anticipate that we will at some point. In fact, we do own an ETF now on the fixed income side. QTIP is an ETF, but on the equity side as well, I suspect that we probably will at some point during the development of these portfolios.
I totally agree. Well, I think we can move on to the next question here, because that was a decent amount of time. But hey, guess what? We're just having fun here. So next question, you mentioned there QTIP, and we did get a lot of questions regarding the fixed income and the bonds discussion in our portfolio. I'll take a moment and pop one up just for example. This one's from Gus. As for the bonds, I completely understand your point, but I wish you would also explain to the viewers that if income is your goal, then bonds fare extremely poor. For example, the returns of Fortis and TD over the past 25 years have returned 2,500% with dividends, TD, etc., while an aggregate bond fund such as VAB, for instance, returned 33%. That's a terrible return. There are great companies and utility companies, for example, that are basically deluxe bonds and provide excellent income no matter what the market is doing and give you the potential for capital gain. So the question there being, why are we holding bonds rather than just getting dividend stocks and really focusing on bringing our income up?
That is an awesome comment, and thank you so much for
Good
the
one.
detail with examples of what your logic is. And superb question. The biggest thing I would say in sort of reply to that is income is clearly a major reason you buy fixed income. The name implies that. But there's also another key reason, and especially right now with the markets being quite highly valued, is there's the diversification aspect. And yeah, bonds, the yields on most bonds right now, unless you're going into the higher risk, high yield, it really sucks. But it's not just the dividend versus
income. Yeah,
it's not just the income. The bonds historically, less so today, but historically have been negatively correlated to equities, and so you're buying them as downside protection, or almost I would say a ballast. So when the markets do go through volatile times, the fixed income portion of your portfolio will provide you with that protection. If you have a real strong fortitude and you go, I don't care how much the markets drop, 40, 50, 60% or 80% like they did back in 2000, I'm going to ride that out. Good for you. Most people don't have that. So when those times arrive, and it's not if, it's when, the bond portion of the portfolio typically will help smooth out that line. And in anticipation of answering this question, I prepared a few quick little graphs, and Brandon, if you could throw those up on the screen.
Yep.
But in the question, you specifically referred to Fortis versus bonds. Great question, and I have a 20-year chart we'll put up here, and it does, in fact, as you can see, show that Fortis has. This is just the total return on both of these investments. XBB is a BlackRock iShares ETF that is just a broad Canadian bond index. So I just use that as sort of a proxy. It would be representative, and you can see over that long time, Fortis has absolutely outpaced the bond ETF. But if we look at the next chart, and I'm just going to focus in on a particularly volatile time, which was back during the credit crisis. So this is 2007 to 2012 rough time frame. And clearly from this chart, you can see the smoothing effect. The orange line is bonds. And although they do go up and down because they are a marketable security, wow, you look at that line compared to Fortis. We love Fortis. I've owned Fortis for many years myself. So this is not a comparison of, this is not slamming Fortis at all. This is just saying these investments behave differently.
Yeah.
And so that's the key reason why we want to have some fixed income. Gee, in 2021, it is hard to get yield. So that's not the main thing. And one last chart, I'll show you the same time period, but just as an example, I think you specifically referred to TD. So this chart will show the same time period as the Fortis. So we went through the credit crisis. So when we saw the sharp drop, the blue line represents TD. And we saw when that crisis hit sort of mid 08 to early 09, the steep drop versus the performance of that bond ETF. Not nearly as exciting. Without question, for the longer term, equities are the way to go. If emotions didn't play a role in investing, bonds wouldn't even have a place in there. But emotions do play a role in investing. So that's the key reason that we believe for most people. And I hear this argument. I've heard this argument a lot over the years, and especially when the markets are hot.
Yeah.
And so you're going to hear it more and more. It comes down to the individual and how much fortitude you have in there to ride out those big storms.
It does. And you do keep in mind, we have so many different levels of viewers watching the channel. Some are beginners, some are quite experienced, and some have been through those ups and downs, and they can make that assessment whether they need the bonds or not. But I think it's actually it's not a bad idea from a starting point for a beginner to at least have those assets which are going to hedge your portfolio, or they're going to provide you with less downside. I think it's crucial. And as we touched on in the last one, even Warren Buffett, he said with his estate, when he gets his money, his instructions to invest his estate, he said a 10% weighting to bonds. So take that from the greatest investor of all time. If you have more experience, yes, you can find other areas, but I think in general, it's unfair to say that bonds, do not deserve a spot in the portfolio, even in the modern day.
Excellent point, Brandon. And two things I'll take away. For those of you who have been following the series, we have two distinct portfolios. We're looking at it from the top down, but we have a growth-oriented portfolio in the Questrade account. We have a more balanced portfolio. You'll see this later on as we come up here, but in Questrade, there are no bonds right now.
Nothing.
I expect we'll probably work some form of bond into there at some point, but when we go through a market correction, that's when it'll be a real teaching point, and we'll see then the effects of how the two different portfolios. And to your point,
Agreed.
it's easier if you've been through market crashes and you know how that's going to affect you. If you feel strong enough to just go into all equities, I mean, go for it. Most people haven't yet, or a lot of people watching these videos haven't. So this is starting from the ground up, building that portfolio, and it's way easier to branch into more aggressive than getting burned out of the gate and then be afraid to invest for the rest of your life. That's not a healthy thing either.
Agreed. Well, speaking of getting burned, let's move on to our next question.
Sure,
because the crypto market has seen a little bit of a little burn over the past while. It's been a bit choppy for anybody that does follow Bitcoin, Ethereum, and the other altcoins and other notable cryptocurrencies. We had a question come in from Alex Cole. Will you guys consider adding any cryptos to the portfolio? I know on Wealthsimple you can trade Bitcoin and Ethereum. Also wondering what your thoughts are on other cryptocurrencies. And maybe we'll just answer for now whether we would consider cryptocurrency as part of an asset in our portfolio. And I have an opinion on that, but maybe we'll hear from you.
Sure, I'll go first, and then you can add to it, Brandon. As far as I'm concerned, and when Brandon and I, discuss what we're going to add to these portfolios, for the time being, I'll say we're not going to add crypto. And the main reason is I don't see crypto, speaking broadly right now, as an investment. I see it purely as a speculative play. Nothing wrong with that if that's what you want to have. But we're teaching how to invest and how to build a property from that, a portfolio from that perspective. At some point, once the industry has matured and settled in, I could see owning crypto. If in fact it continues to make advances and become more accepted, I'm still not convinced of that. There's so much evidence coming out of the industry, if you call it an industry, of the product being misused. And I just can't see the governments of the world standing by and just going, okay, we're going to let this all happen. The banks are regulated, but you aren't. I expect at some point we're going to see much more crackdown in that regard, which of course would be just very detrimental to the industry. So I don't see us using it now. Could it come at some point? I would say yeah, absolutely. But just for me, at this point, it's not an investment. It's a speculation, and that's not what we're doing with these portfolios.
And I 100% agree. My input is actually, in terms of these portfolios, I totally agree. I don't think there is a need immediately for that. As you said, as time goes on, and if we can really see these, how these assets correlate, and if we can make a fair argument that this would be a benefit to our portfolios here on the channel, then absolutely, I think that's very fair. I don't think I would buy the crypto on Wealthsimple trade to begin with. That's just a personal reason. I actually did own some Bitcoin. Difference in opinion here, Dad, because maybe I'm a bit younger and this is a speculation that I'm willing to make. I did own some Bitcoin, which I talked about on the channel over the past couple of years, and they did quite well. Unfortunately, it was $1,000 of play money, which I ended up selling for $7,000. So, I mean, not a bad return over a 1 year period. But point being, that is... if I were to invest in crypto, it would just be simply for the fun of it rather than it being part of our actual portfolio here. That's just the way I'm approaching crypto. Obviously a fun market to keep involved with and stay on top of. But as you said, as much as some people would consider it an investment, I would still believe it is a speculation at this point, especially as you get down into the more smaller coins and the other assets there. It's just a gambler's paradise in my opinion.
I'm just thinking if we want, though, to be instructional, man, we should have bought it a month ago when we started these portfolios because, I don't know what the numbers are, but I mean, the coins in general, I think Bitcoin
down 30% or so,
roughly. And so when you started off by saying this is up 6 or up 3 or down 1, we could have shown in front of your face, this is what the potential are. Mind you, it can go up 1,000% too. So that's the difference, right?
Right.
Predictability.
Well, we're not trying to lose money out here. We're trying to make some money. But let's move on to our next. Thank you guys for the questions. First of all, phenomenal. As always, if you have more for the upcoming session, please do leave them down below because we will factor in all of these. But let's move on to talk a little bit about the stocks that we added. And maybe you actually added two.
So sorry to interrupt. We were going to talk very quickly about drips because we had a question about drips and representing. Like so many people ask, should we drip or should we not? So can we talk about that just for 1 minute?
Good catch. So I totally skipped it. You're on top of the ball today, Dad.
Yeah, just had my morning coffee. I'm good. So
Nice.
Most people know what that is, but for those who don't know what DRIP is, a DRIP, dividend reinvestment program or dividend plan. And essentially what that means is when you own a stock, you can arrange in many cases, so when they pay a dividend, it just goes back to buy more shares of the same company. And it's very simple, and it's very popular with a lot of people. There are some advantages such as no commissions and that type of thing. Just cutting to the chase, we have rarely ever used drips, and the main reason that we like it, or we don't like the program, is because we like to have control of when the money comes into the portfolio, what we're going to do with that. And the simplest example I can give is if a company has been doing particularly well and they pay a dividend, we may not want to buy more shares of that company at a higher, if it's trading at a high valuation. And conversely, if a company has gone through a rough patch, but we still see value in the company, very commonly, I would rather take that drip, the dividend from the higher valued company today, and reemploy that buying something that has, it maybe has a low valuation that we feel will come up, because all of these equities go through cycles and they regress to that mean. And so that's just a strategy that we use. It just comes down to control of those assets and not just automatically buying shares of higher priced assets. So there's no perfect answer on that.
There's no perfect answer. And again, as you mentioned at that first question, it depends on the investor. As we said, we are planning to be more hands-on with this portfolio versus somebody that doesn't want to look at their portfolio and they want to be hands-off. Well, the drip could be the perfect solution.
Yes.
That said, one consideration too that needs to be understood in the Canadian market, our Wealthsimple trade account does not currently offer drips even as an option. And that's, of course, our dividend-focused program, our portfolio, I should say. So that in and of itself answers the question. Even if we did want to drip on Wealthsimple Trade, we can't. Again, one of those limitations of respective portfolios, but just something to be aware about, even though we wouldn't do it anyways.
Good. So thanks for allowing me that extra 2 minutes probably, but we got to move along here for sure.
Good catch. No, that was, I totally skipped over that question, but let's move on to the stocks that we've added. And you added two holdings to the portfolio over the past, or since our past review. I added one. Why don't you go through one? I'll hit one, and then we'll bounce back to you to wrap up this video.
Sounds good. What I will do is I will start with a company that I added fairly recently, and it's Kirkland Gold, and the ticker on Kirkland is KL. Trades on the Toronto Stock Exchange, also trades to south of the border in the U.S. Now, I know, Brandon, you did a fairly recent video talking about stocks that you may want to buy in inflationary times. So I'm not going to go into a really deep dive on this, but that's the main logic. I know last time around we talked about buying the Q-tip inflation-adjusted bonds for protection against rising inflation, and I've prepared a quick chart I'm going to show up. This is just the most recent numbers that came out of our the StatsCan, I guess, or the government reporting, and it's showing that there's no question. We've been talking, is inflation going to be a problem, and we'll see how that's really ticked up in the last little while here. So a big focus of taking this position, and we've heard forever gold is a hedge against inflation, and gold is incredibly, the sector itself is very volatile compared to a lot of other sectors. And so I had clients literally who would never want to own gold. They don't care what protection it can give you. It's not uncommon for the sector to drop 50% in a short period of time. So from purely the capital preservation, you've got to understand that if you're going to add gold. But for the purposes of rounding out the portfolio in the times we're in right now, we added Kirkland Gold. There is that benefit. We just think it's also a good company as well. Just some recent numbers on it. If you look just from a valuation perspective, from a price earnings perspective, it's trading with a trailing price earnings of 12, just around 13%. Now that compares to their 5-year average of 13 times versus their 5-year average of 19. So that would imply, all else being equal, that they're undervalued. The sector median there is in that space is almost 23. From a price to book, or I'll look first at the PE, the forward price to earnings, 13 currently versus 53, still less than their average, and certainly less than the 16.5 earnings that the sector pays off. And lastly, on the valuation perspective, from a price to book, 2.2 is what their price to book ratio is right now versus 3.5 5-year average, and 2.6. So I think that 2.6 for the sector median. I think that there is a lot of value in the company. In other words, I think that's undervalued right now. In their most recent report, again, this is not a deep dive into Kirkland. The goal here is to say, here's some companies that we think are good, but everybody has to do their own research on it. We'll leave most of that to each individual. But in their most recent report, you'll see their various properties, and Detour Lake is just the star of the show. Really importantly, they have a 22-year production life, and when you're dealing with a depleting asset, you always have to look out at the lifespan of that to make sure that it's going to be viable, not just for the short term. Growth is increasing, and importantly, they're anticipating at least a reduction in the costs as well. So you marry all those things together, and then lastly, I would say on this topic, they've been buying back shares, and they pay off a reasonable dividend. So when you combine those, I think that Kirkland
it made sense.
Yeah, it makes sense to add it from an investment perspective, which is always the most important thing in the economic times we're in right now, from that inflation hedge as well. It just does make a lot of sense. We took just a normal position in it, not overweight, not underweight, just a reasonable position in it.
And just to clarify, we did make that purchase on Wealthsimple Trade. That is a Canadian traded stock. I'll see if I can actually pop up the exact trade for you guys if I'm able to find that on the screen here. And do keep in mind, if you want to follow along with these trades live, we have a private membership group where we showcase every single trade we make. We have top stock ideas. We have a variety of other tools. You can learn about that all down below. And if you are watching this before Monday, because I should be posting this on Sunday if that's when you're watching it, you have about a day to get in before our price increase. And you can learn about that down below. The price that you pay, that will lock in your membership costs going forward. And we are continuously going to raise the price as we get more and more members and as our group continues to grow. So check that out down below. But I can move on into my stock pick, which I don't think will be as long because, again, I've covered the stock a million times too.
Yeah.
But we added the company Tencent Holdings, ticker TCEHY. This was a stock that we did add in the Questrade portfolio. US stock, we bought 20 shares at a price of about $80.85 USD. This was the equivalent, FYI, of about $1,600 invested. And one little teaching point on this, because this is a stock that trades over the counter, meaning it's not listed on a major exchange, okay? You're not going to buy this on the New York Stock Exchange or the TSX or one of the major notable exchanges. This is a Chinese company that trades as an ADR. You do use a limit order on Questrade, meaning rather than just placing a market order and getting your order filled right off the bat, you actually set a price that you're willing to pay. And in this price, our order got filled at, again, 20 shares at $80.85. So that is just one little consideration. We weighed the pros and cons of this one, Dad. Getting some exposure to China, which is a higher risk area. I actually saw a post, I believe a couple days ago, Biden banned, or they're against some Chinese investments in military and aeronautics stocks. That's a perfect example of the risk that comes with investing in Asia. You always hear people talk about, this foreign risk and international risk. Well, that's a prime example, and these things are legitimate and they are something to factor in. That said, Tencent, first of all, doesn't fall into those types of companies. As part of our research, this stock has a price target of about $103 USD based on Morningstar standard. That represents about a 23% discount. And as I've said multiple times on the channel, Tencent is actually one of my little gems, one of my picks that I've been very much favoring over the past number of years. I'll link some videos up at the top if you'd like to go look those up, or just Google search. On YouTube, just search up my name and then Tencent. I'm sure a number of videos will come up. But again, we added that to the Wealthsimple portfolio. So those were 2 out of our 3 holdings. And you added one more, which I think you can take away.
Yeah, and I'll just add to that, to your discussion there, Brandon. As you noted, Tencent is in the growth portfolio. I think you'd have a hard time convincing me to put that into the balanced portfolio just because of that added risk. But certainly for a growth-oriented investor, I think it's a good choice. So, awesome. Thanks for allowing me to add that. Now, the third that we added this time is the U.S. company Pfizer. And the ticker is PFE. And clearly, Pfizer has been in the news a lot lately, and they've really benefited from...
I got the Pfizer one, actually.
You bought... you got the Pfizer shot just a couple days ago, right?
I just took off the Band-Aid before filming this video.
You should have left it on for a few sympathy thumbs up, maybe. Sympathy likes. Who knows? So Pfizer is clearly a huge in the vaccination industry, but Pfizer has been a very solid company for a long time pre-COVID-19, and the big thing I see with Pfizer right now is that the mRNA technology that they're using as opposed to traditional vaccinations, really the entire world, a field of vaccines, I think is changing with this bout and the rapid development. And I've read that the technology being used is focused clearly right now on this pandemic. But because they're making those DNA adjustments or whatever technically they do inside your body, this will be suitable for a lot of other applications as well. So when COVID is behind us, hopefully before too long, this will be building that foundation for using this technology in future applications. But COVID isn't behind us. In fact, the last I read is Pfizer is projecting 3 billion doses in 2022. So, I mean, there's still a lot this year. And in fact, in their most recent reporting, the COVID-19 vaccine was their largest selling drug of a lot of really large selling drugs. So, there's, and on that note, the other drugs are years away from expiration on their patents. And that's always an issue you have to be mindful of the large tech companies that spend $1 billion or so to create a new drug. And then, they have a lifespan until the generic drugs come online and compete against them. Purely from a financial perspective, we look at the valuation. They are paying a reasonable dividend of 4%. Their forward PE is 10.51 as of the time they were filming this. That's about 20% below their 5-year average of 13.2 and way below the sector median of 23.76. And so when you look at those numbers from a valuation, again, there's we're trying to add to the space. I think this is the first healthcare company that we've added to these portfolios. Healthcare is something that deserves a spot in all portfolios, I would say. And so for that reason, trading at a reasonable valuation right now, all those things factored in, we felt it would be good to add depth to the portfolio. And I think we're going to be looking shortly at sort of the composition of where we're at today and looking at which sectors we're in and which sectors we're not in and where we'll go from there.
Yeah, well, no. I mean, what I'll do is I'll actually pop up on the screen just to recap again. I'll share the actual inside of the brokerage accounts to show the holdings. It may make a little more sense now that we've gone through the stock picks. On the screen, again, you're looking at Questrade, which is our more growth focused, entirely US at the moment. And then over on Wealthsimple trade, you'll notice here, predominantly Canadian. You do see the new Kirkland Lake position, very in line, holding-wise, position-wise, size, with the rest of our holdings. We are, again, a little more spread thin amongst Wealthsimple, and that's a luxury. To talk about a benefit of Wealthsimple trade, that's a luxury of having no commissions, right? It's not the end of the world paying a $5 commission versus not, but it's just one of those considerations where we can buy more frequently. We can spread those eggs thinner without worrying about our friction costs of commissions on Wealthsimple versus Questrade. Yeah, we do want to be a little bit more cognizant, but again, $5 at the end of the day is not going to make or break us. Do you have what's up?
Yeah, go ahead, Brandon.
I was going to say, do you have those ready? The breakdowns of... the spreadsheet that we created that shows the breakdown. So we can throw I've got the 3 spreadsheets. So one shows the portfolios combined, and then we show the Questrade and the Wealthsimple. So let's put the combined one up first. And so with this shows us a few things. At the top, sort of the major breakdown, we have about 42% in equity so far, 4.5% in fixed income, and about 53% in cash. And yes, that's way more cash than we want to have. And just a quick aside, one of the comments or one of the questions we got was, well, if you believe the markets go up over time, why don't you just invest all the money at once? Wouldn't that make sense? And it certainly can. I think they actually said that we are basically timing the market by...
Yes. The question was, are you timing the market?
Yeah.
And I would say no. In fact, sort of intuitively, I say we're not timing the market because it's just that dollar cost average in. And if let's say we build up and we end up, in the next short while, we'll say 15 companies. In the next 6 months or the next year, we're going to see all kinds of gyrations. We're going to see companies doing really well. We're going to see some of those picks doing poorly. I guess, we do our work, pick, with the best odds, but some of them are going to underperform. Well, you want to have some gunpowder or some powder on the side that you can go in and dollar cost average in and pick up some additional shares. So I don't think that there is a magic bullet where a perfect answer. I just know what I've done over the years, and it's worked out quite well in the shorter term, is to build the portfolio. So right now we have about half of it into the markets, just slightly less than that. And we're going to continue to buy in the coming weeks and months. And, I don't know, a question was, how long will it take you to get to full
fully invested. Yeah.
Yeah. So the question is somewhat depending on what the markets do. I think if the markets correct soon, that will speed that process up because there's nothing like a good market correction to buy some good companies on sale. If the market continues to climb this way, it'll be more selective and a little bit more difficult to build it up. But I wouldn't think it would be more than a few months at the longest. But that will be somewhat dictated. So just back to the screen, you can see on the left side of this chart, Brandon, if you could zoom in on that, the sector allocation. We've got most of the sectors now covered. You'll see real estate and utilities. We still don't have any direct investments in those spaces. And then we don't have any sort of what I call diversified categories, such as, global ETFs or that's more for an ETF type thing. And on the right side, you'll see where we have the holdings. So there's a total of 14 holdings right now. And the weighting that each of those represents from the top down. So these are the combined. So the largest holding is Alphabet, which represents just under 7% of the portfolio, the smallest being Enbridge at 2%. If we flip on the next chart, which shows the Questrade growth in more detail, you'll see that is 53, almost 54% invested, 46% still in cash, waiting to be put in. You'll notice on the left side, the sector allocation, a much more concentrated portfolio. And this is typically what you're going to see in a more growth oriented. You're going to see, IT, you're going to see some industrials and healthcare. It's very common because this is where the growth oriented companies tend to be. On the right side of this, you see Alphabet at 13% of the portfolio in all. And the smallest here is 7.32%. With that Pfizer represents. So compared to those smaller percentages, much more concentrated. Again, this is the whole strategy of this portfolio. Now we'll contrast that to the balanced portfolio, which shows more sectors covered off, but not all. Still quite a few to go. And I think that ultimately, in a balanced portfolio, you do want to have exposure to all of the sectors at most of the time. There may be times where you're going to eliminate a sector or two, but for the most part, almost by definition, to be balanced, you need to have that. The right-hand side shows the largest holding, aside from the bond ETF, which is 9%, but CNR is 5%. We're comfortable somewhere in that 2 to 5% range of having an asset represented there. Those numbers will come down implicitly as you start taking some cash and adding additional cash every month and adding more securities. Those numbers will come down to represent a smaller, sort of normally in the 3% part of that particular portfolio. So that's kind of a more granular breakdown, and we're going to update this every time we do an update so you can hopefully get the concept of the contrast between growth and balance, and then again, overall, how we're building that up. And it's just sort of a little deeper dive into the actual construction of the portfolio, which is what this series is all about.
That was so well explained, Dad. And yeah, that's the point, is we're showcasing two different ideas. You may be watching at this point and saying, well, this actually makes more sense for me, or I like spreading my eggs a little thinner here, because we don't know what your situation is like. You're the one that can make that assessment best for yourself. And there are so many factors, such as your age, such as how risky you want to be, such as how close you are to retirement. All of these things come into play when deciding how you're going to build your portfolio. And even just we're on episode 4 here, 4 sessions in, we're starting to see that divergence, which is basically how we planned. And it's just going to become, I think, more and more apparent with time.
Well, what you just said, Brandon, was really important. Just to reiterate that, every single person watching this has different. It's kind of just popped into my mind is if you're going to go and build yourself a house, there are the rules of building a house, but every house is going to be a little bit different, and so you tailor this to your own circumstances, which we can't know. So I know we're going to get some comments saying that balancing is stupid, like you should buy more growth, and maybe vice versa. That's fine, because whatever works for you, run with that.
Exactly. Well, that is gonna wrap up, I think, this session here, because we're getting pretty deep into it and we've covered our stocks. Again, just to bring you up to a grand total, we're sitting at a portfolio today of $41,956.08, and I'm excited to see this one grow. I think do we have anything else to talk about in this particular lesson? I think each lesson we're going to kind of...
I'm just thinking right now, we could talk for the next 2 hours about this, but people don't have 2 hours to sit around. I think what we'll try and do for every single episode is certainly answer some of the questions. A reminder, like a question that you see, or add your own question. And I think that's a really critical part of this whole exercise. It lets us know what the questions are. And then obviously talk about what we've added and a little bit of logic as, whether you add those companies or something similar to those, it gives you the idea of sort of the thought process behind it. And just keep building it up, and it'll get to the point where we are fully invested, and then who knows where we'll go from there, maybe maintaining a portfolio, but we'll play that.
Exactly.
We'll cross that bridge when we get to it.
And I think each lesson and episode can kind of have its own little flavor. We talk about a specific lesson in that. And this was more or less just showcasing the 3 stocks we added. A couple weeks from now, maybe we dial into a specific topic that we'd like to cover or educate on. And we'll cross that bridge when we get there. But for now, I want to say thank you to everybody that has been tuning along this far, and you make it to the end of the video. As we mentioned, the thumbs up go a long way, both in the comments and on this video. If you guys are appreciating this series, take a moment to drop a big thumbs up. I'll remind you, you probably have a day, depending on when you're watching this, to get in at our private membership group at the lower cost. That's that first link down below. We also do have our training programs. If you are looking to learn more, you can learn all about that through our Investing Academy, and just leave us some comments down below. We are so curious to hear what everyone's saying, what everyone's thinking about the challenge. And I think really that can kind of wrap up this session right here, Dad.
I think that's good, Brad. It's been good seeing you, and look forward to our next update here. I know we'll be doing some videos, between now and then. So
definitely. Well, let's wrap that up here.
Beautiful.
Thank you guys all for tuning in to the episode 4 of our challenge. We do have a playlist up on the channel. If you do want to go back and watch it from scratch, that'll be fun to kind of see the progression. But as always, we thank you guys for watching for this one.
Thanks so much.
We hope you enjoyed, and we'll see you in the next video.